The communication services sector has been turned on its head lately, adding in companies from Facebook to Disney and Netflix. From 5G stocks to traditional telecom plays, there's a lot of opportunity here, but a lot of risk also in those streaming wars. I'll show you how to pick stocks in the sector and reveal my top stocks to buy for your 2020 portfolio. We're talking communication services stocks today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, few stock sectors are going through as much change as this communication sector. Between the rollout of 5G and the intensifying streaming war, the sector represents some huge returns, but also big risks for investors. You absolutely must know this sector, the opportunities and the risks in these stocks. That's what we're going to be talking about in this video. I'm going to walk you through how to look at this new telecom and 5G sector of stocks, what to look for in these companies. And then I'm going to reveal 2 communication sector stock funds and 5 stocks to put on your watch list for 2020. It's part of our 11 video series uncovering the best companies in each stock sector. Over these 11 episodes, one for each stock sector in the market, I'll show you how to pick the best of breed in each. We'll look at some of the big trends and how to pick stocks to buy, then I'll reveal my 5 favorite stocks in each group. If you're coming in later to the series, I'll link in the first comment below the video to the most recent video. I'll also be linking in the video description all the videos in the series so you can see all the stocks from each sector. So here's what we're looking at when we talk about this communication services sector. And I actually had to update this graphic that we've been using throughout the series to include these new industries. In this sector, you've got the old school telecom players in wireless and broadband, but also a lot of entertainment companies, internet services, and those media groups. You see, back in 2018, S&P and MSCI, those are 2 of the largest index providers, said they were going to change this old telecom sector to a new communication services sector to reflect more than just those old line telephone companies. They pulled in a lot of industries from the consumer discretionary and the tech space. Companies like Facebook, Netflix, and Disney were put into this new sector. Now, it actually took it from being one of the smallest sectors of the market, one of the smallest sectors in the economy by market size, to one of the largest. To put it another way, those old telecom stocks, the AT&T, the Verizons, now make up just 11% of that sector. So this basically changed it, just blew the group up by a factor of 10 times. So we're talking about a lot of different industries and business models here, and that's always dangerous when you're talking about a sector as a whole. The stocks in this new sector have produced a 9.9% annualized return over the last decade and a 12.7% return over the last 5 years. Now that's a little under the average return on the overall stock market, and basically you see a lot of these internet names and the FANG stocks have outperformed, while some of those older telecom stocks have lagged the rest of the market. On a price to earnings basis, it's one of the more expensive sectors in the market. You see here on this fact set chart that we've been using through the series, it shows the price of stocks in the sector versus the forward earnings expected by analysts. So that PE ratio, price to earnings ratio, based on earnings expected over the next year. The communication services sector is there in the middle with that PE ratio of 17.2 times, just over the price to earnings ratio of that overall stock market. Now there are 2 things to remember here though. First is that we're not just talking about how expensive the stocks are in the sector or against the market, but also how expensive they are against their own PE history. We'll get to that next, but also though, you've got to remember that the huge difference in these companies now in this index. Within this sector now, you've got those old telecom sector stocks that are trading at maybe 10 times earnings, which is actually probably about right for that level of growth. You've also got those internet stocks though trading for 25 and 30 times earnings, which might also be okay for their level of growth. So that 17 times price to earnings ratio might not be as cheap as it looks given those different stocks in here. If you look at that 10-year average PE ratio on the sector, so that green bar and a 14.6 average, we see that stocks in the sector are trading at a premium of 20% to their long-term average. Now this isn't as expensive as that 30% premium we see on tech stocks or utilities, but it's still 20% more than you would have paid over that longer run average. Now I've actually got mixed feelings about the stocks in this sector though. Okay, so you've got some massive potential in those old telecom names and 5G stocks. These companies have been investing billions in their 5G networks for years and are now ready to start reaping the reward over those next coming years. Capital spending should come down and cash flow should increase for these companies, which is always a recipe for higher earnings. And with 5G, you're going to see an explosion in electronic devices that connect to the internet. So this revolution is called the Internet of Things, or IoT, and it should help those telecom players as well as some of the other companies in the sectors like appliance manufacturers. Another industry that nobody is talking about in this sector though, and one that I'm going to highlight in our 5 stocks to watch, is media advertising. Now, internet ad spending is expected to approach $300 billion this year, and it's going to account for more than half of all advertising dollars within just the next couple of years. Now, that is a big opportunity for some of the stocks in this sector. Against all this optimism, though, for some of these trends, those first shots are just being fired in the streaming wars, and this is going to be bloody over the next few years. Netflix has always been a big spender on producing its shows, but that's going to go into overdrive against some of this new competition from a string of big media companies. Now, not every company is releasing exactly how much it's going to spend on streaming content. For example, Disney has budgeted $23 billion for everything, and has given clues that streaming is going to be at least $2.5 to $3 billion of that. Between just these 7 players here that you see in the chart, you've got almost $50 billion in cash flow going to produce that streaming content. Now, I'm not denying that streaming platforms are going to bring in the dollars. Online and mobile viewership is still growing, but that race to produce content, the billions spent on the hope that subscribers will come, I just don't think it's going to play out as well as these companies or investors think. Now, this is why Google-owned YouTube shut down its own content production house earlier in the year and is really just doubling down on user-generated content. It's an arms race in content, and nobody's going to win here. So before we get to those 5 telecom and 5G stocks that I think you should be watching, I want to highlight a couple of funds here. First is this Communication Services Select Sector Spider, ticker XLC, and this might be an easy way to get that growth in 5G or Internet of Things along with the stability in telecom. The fund holds 27 companies with an average market cap of $385 billion. So we're talking massive companies here, including Facebook, Alphabet, which is the old Google, and Disney. You can see that old school telecom is just over 13% of the portfolio, with the other 3 industries representing a much larger chunk. Now, this one only pays a 0.9% dividend yield, so not what you'd expect from those old telecom stocks, but it's on those new internet and media companies that aren't paying anything. A good alternative here with a global perspective is the iShares Global Communication Services ETF, or ticker IXP. This one charges a higher expense ratio at 0.46%, but also a 3% dividend yield and really some broader exposure to more companies. This one holds shares in 69 companies with about 2/3 based in the US, but also some exposure to Asia and Europe companies in the list. Because of that exposure to US companies, it's going to follow the larger communication services fund pretty closely. Here we see a 1-year chart with a global fund in green and the XLC in red. Now, the global fund has underperformed significantly on strength in the US dollar as well as growing US economy, but I think the smaller fund has a chance to outperform over the next year or two. Now I want to get to those 5 stocks that made the list. 5 stocks to watch from this sector for your 2020 portfolio. A couple of notes here. I used the same screener that we've been using in these other videos, so if you haven't watched our first video on tech stocks to buy, check that out because I detailed the factors that I'm using to pick these stocks. Now, I also tried to pull some of the best stocks from different themes or different industries for the list. I pretty much avoided those streaming war stocks for the reasons that we've talked about, but did grab another media name. Verizon Communications, ticker VZ, is my favorite pure play on that telecom space with a 4% dividend yield. Now, I know a lot of you in the nation love AT&T, but it's got so many things going on right now, from Time Warner acquisition and DirecTV and streaming. Besides trying to fight those streaming wars, there are a lot of balls up in the air right now, and I think something's going to get dropped. Verizon is just much more of a pure play on that 5G story, with 70% of its revenue from wireless. It still has some fixed line operations as well, which are about 12% of the revenue, and enterprise services make up 10% of sales. Wireless customer growth has been really strong this year. In fact, the company just reported its strongest 3rd quarter in 5 years, adding over 400,000 customers. Sales per account is also growing, doubling from a year ago. Now, shares are trading for just over 12 times earnings, which are expected to grow 2.9% over the next year, but could add another % or 2 on management's history of beating expectations. Analysts have a low target on the shares at $55, with an upside to $70 per share on the high end. And remember, this is on top of that dividend yield. That increasing digital ad spending should help the Interpublic Group, ticker IPG, as the 4th largest ad company in the world. Now, the 2018 acquisition of data solutions provider Axiom helped expand IPG into that digital marketing data space. Shares have been flat for the better part of a few years, and some significant customer losses over the last year held the company back, but things are starting to turn around and could look better for 2020. Shares trade for just 11.4 times earnings, which are expected flat over the next year, but will likely be a few percent higher given management's history of beating these expectations. Now, there are only 2 analysts covering these shares here, so tough to read anything from the chart, but a low target of $23 a share and $26 at the high end. That's on top of that 4% dividend yield, and this could be the surprise stock of 2020. Next is WPP at $16 billion, the largest advertising company in the world with traditional and digital ads, public relations, and consulting business. Now, WPP is based in the UK, but truly a global company doing business in over 100 countries. The shares have been under pressure with the last couple of years, but signs of a turnaround are beginning to show here. The company reported revenue growth in the first 3 quarters with some big account wins like Huawei in China and Signet in North America. WPP cut more than 700 million British pounds of debt off of its balance sheet over the last year and is expecting $3.1 billion from the Kantar disposition expected in 2020. Shares trade for about 15 times earnings and pay a solid 6% dividend yield with some further price appreciation on the upside. Now, China Mobile, ticker CHL, is not only one of the strongest telecom plays, but also a great way to get exposure to that Chinese consumer market. The telecom company controls 61% of the 4G market and 60% of the total wireless market in China. With 916 million subscribers, it's the largest telecom in the world, and despite this ginormous size already, it's still posting some astonishing growth. China Mobile also became the country's largest fixed broadband provider last year, controlling 42% of that market and accounting for 73% of all new broadband customers versus those other 2 telecoms in the country, China Unicom and China Telecom. Now, China is determined to be the leader in 5G, and it's said so publicly, and this is one of the first tech evolutions where it could really have the chance to set that pace, and it's going to do it. That's going to open up a lot of opportunity for telecoms and that broader economy. IoT smart connections among corporate clients increased 154% in the first half of last year to 384 million. That's already more than the entire population of the United States. Shares pay a 5% dividend yield, and the company only pays out 48% of its profits to cover that dividend, which is still solid, but obviously leaves a lot of room for growth. At a price-to-sales ratio of 1.6 times, which is well under the 2.1 times average over the last 5 years, these shares are a good deal here for new investors. News Corp, ticker NWS, is probably going to surprise a lot of you, but I think there's more here than the market is seeing. This is a much smaller company after the Fox spinoff and the sale of the assets to Disney. About a third of the operating profits come from that traditional print media business, but News Corp also has its hand in Australian pay TV and digital real estate advertising. Its digital ad business is doing well and I think underappreciated by the market. Shares trade for 39 times earnings, which is pretty darn expensive, and earnings are actually expected lower over the next year. I think the company could announce a few more asset sales though, which could really boost this cash position. The company has a strong balance sheet with $700 million in net cash, very little debt, and still some strong brands in its portfolio. I'm following Warren Buffett into 5 bank stocks in the video on the right. Some of these are trading on a huge discount to fair value and could produce strong double-digit returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.